Thank you very much. It's a great pleasure to be here, my first time in Lisbon. And I really enjoyed the city, despite the rain. I managed to walk around yesterday. It was lovely. Okay. Well, today the topic of my discussion is financial inclusion. It's based on a synthesis of significant amount of data and research work that we've done both at the bank and elsewhere. And it has significant relevance for Africa, so we decided that this is a good topic to talk about today. I am having a little bit of a So just to tell you a little bit why this topic, there has been a significant increase in this sort of interest in this issue in the policy agenda. G20 and other international fora focus on financial inclusion. Around more than 50 countries, our client countries, have been adopting strategies to increase financial inclusion. The bank's president has sort of set a target of universal financial access by 2020. Over 2/3 of bank regulators in developing countries now have expanding financial inclusion as one of their policy targets. So, and more fundamentally, in theory, we know that financial inclusion or having access to finance is an important component of promoting growth and reducing poverty. Access to finance enables poor people to save and borrow and to build their assets, and for entrepreneurs to take advantage of promising growth opportunities and therefore lift themselves out of poverty. Now, but more importantly, the reason we've decided to do this at this point in time is we have been putting together a major database to benchmark financial inclusion around the world, and both at the bank and outside there's been a significant amount of empirical work as well to sort of study the impact of financial inclusion on development outcomes. So this was a good time to synthesize this, and the work we've done aims to highlight the evidence and therefore provide an evidence-based roadmap for financial inclusion to guide policy. Okay, it's important to clearly define what we mean by financial inclusion before we move ahead. We define it as the proportion of households and firms that use financial services. But use and access are clearly different concepts, because we do know, we can observe use when we look at the population. However, even if there are non-users, some of those still have access to finance, because some of the people who have access will exclude themselves voluntarily, simply because they don't have a need for financial services, or they have cultural or religious reasons, or they have access indirectly. But there are obviously other segments of the population which will be excluded involuntarily. And of those, there are some that have insufficient income or want to fund high-risk projects which are not necessarily our concern. Those that are excluded because of barriers and lack of discrimination, lack of information, weak contract enforcement, all sorts of price barriers, which are actually symptoms of more underlying structural issues such as lack of competition and information transaction costs, are the ones that we want to address by policy by removing the barriers. So it's important not to only look at the use, but also try to get a better understanding of the barriers that individuals face in order to provide some guidance as to how policy should address these barriers. All right, so as I mentioned, in 2011, we've actually been able to launch a new database called Global Findex in partnership with the Gates Foundation and as part of the global world poll that Gallup Corporation does. And for the first time, we managed to measure financial inclusion in 148 countries, over 150,000 adults, representing over 97% of the population. Usually when we talk about financial sector, data is easy to come by. However, before we did this study in terms of financial inclusion, it was very hard to figure out what proportion of individuals in which countries have used which types of financial services. So this was important for us to have a benchmark of financial inclusion across the world for the first time. So as a result of this, we know that globally about 50% of adults have a bank account. So they're formally included in the financial sector because having a bank account is something that we consider to be as the first step in being included in the formal financial system. But the rest of them, about 2.5 billion, remain unbanked. And we're looking, when we talk about adults, these are adults over 15 years of age. And we also see that there are significant differences across countries. In high-income countries, the inclusion rate is about 89%. This is compared to 41% in developing countries. In Africa, this figure goes down to about a quarter. And obviously, there's also quite a bit of difference across different countries in Africa as well. There's also significant differences across women and men, gender differences. Women tend to be 15% less likely than men to have an account. Partly that's because they tend to use other people's accounts. Although there is some indirect access of that sort, we know that that has implications for empowerment. Okay, so as I mentioned, it's important to try to understand what are some of the reasons for this type of exclusion. And there are self-reported reasons that we were able to capture through these global survey. The bulk of the individuals, about 30% of those who do not use a bank account, say it's because they don't have enough money, as we would expect. But then there are other reasons, such as other family member having accounts being too expensive, too far away, lack of documentation, lack of trust, religious reasons. Clearly, these are subjective responses, but when we try to sort of correlate these with more objective measures, such as fees on checking accounts or bank branch penetration, we do find significant and high correlations even after controlling for GDP per capita. So these do indicate some sort of measures that one could address, or symptoms of some of the underlying structural problems. So continuing with the trying to sort of look at this database, it's more or less sophisticated partial correlations at this stage, because this is the data that's available on a cross-country basis at one point in time. We have plans to repeat this every 3 years, at least for 2 more rounds. So the next round is going to be coming out next spring. But just looking at this individual level data and trying to understand the correlates of individual and country characteristics with financial inclusion, we do see some things that we actually expect to see. For example, we do see that individuals that are richer tend to be better included, more educated, employed individuals, those who live in cities, as one would expect. But there's also some other associations, such as better enabling environment in the banking sector is associated with higher inclusion, such as lower banking costs, greater proximity to financial service providers, fewer documentation requirements to open an account. And there's also some suggestive evidence that policies targeted at financial inclusion, such as offering basic or low-fee accounts, granting exemptions from online documentation requirements for such accounts, allowing correspondent banking, also using bank accounts to make government payments to individuals, all tend to be associated with greater inclusion of the segments of the society who tend to be more excluded, such as the poor and the rural. Okay, so we also see that, interestingly, financial inclusion increases with economic development, and indeed, as the income increases, inclusion also tends to be universal for the most part. But what's more interesting in this figure, I think, is the fact that as you go to the left with lower levels of GDP per capita, you see very significant dispersion. So countries at low levels of income can actually have very different levels of financial inclusion. So this suggests it's not only income, that there is also room for policy. And as you know, there is a very significant focus on inequality these days, and some of these partial correlations also suggest that financial inequality and economic inequality are closely correlated. The account penetration in the richest 20% as a multiple of the poorest 20% increases significantly as income inequality increases as well. So far, those are interesting partial correlations. Of course, the report we've done synthesizes the significant amount of rigorous research that we have been conducting on the impact of financial inclusion on development outcomes as well. And just to summarize some of the findings from that research is we see that from various studies that the empirical evidence on the impact really varies by the type of financial services. So it's not all the same. When you look at basic payments and savings services, there is a very significant and strong evidence on the benefits, especially for the poor. We have studies by Ashraf and Farlam, Juan Robinson, that show that increasing savings and productive investment go hand in hand, being able to have access to a basic payments account. It's also correlated with actually in a determining fashion women's empowerment, health, all sorts of positive development outcomes. Now, when we look at insurance products, there is also some evidence of a positive impact. Insured farmers, for example, tend to increase their productivity and move to higher return, higher risk cash crops. And there is, again, significant recent evidence that shows these. But there is also challenges in increasing the take-up of insurance products that I'll mention in a minute. Finally, most of the time when people talk about inclusion, most of us think about access to credit almost immediately. That's where there is a little bit more mixed evidence. When you look at firms, obviously there's by now a very significant sort of body of literature that suggests that access to finance, being able to borrow, it has a very positive effect on growth, especially for startups, for small and medium enterprises. But when one looks at micro enterprises and individuals, the evidence there is much more mixed. The original narrative that microfinance was supposed to unleash the productive potential of the poor and therefore sort of lead to growth did not necessarily materialize because micro-entrepreneurs tend to be a heterogeneous group. Some of them prefer to use the funds in order to smooth consumption or risk management, which obviously has welfare consequences, but it's not necessarily as clearly associated with growth. And indeed, more recently, there are macro studies by Rob Thompson and by his colleagues that suggest that at the aggregate level as well, there isn't that much of a significant relationship between use of microcredit and growth and productivity increases. So the message here is much more nuanced than once believed. All right, so what do we say in terms of financial expanding financial inclusion. And we want to make sure that this is done responsibly and in a way that is solidly based on empirical evidence as to how it's to be effective. Clearly, one of the important policy implications of all this work, both data and critical analysis and also theory, is that policy should be focusing on addressing market and government failures and not necessarily trying to promote inclusion for inclusion's sake, and certainly not trying to make everybody borrow, because we know how that could backfire, as we've seen in the latest financial crisis. We also know from the significant amount of work that we've done is that direct government interventions in the credit markets tend to be politicized and less successful, and particularly in weak institutional environments. So the role for government is actually mostly in creating the enabling environment. So one element of that is certainly the legal and regulatory framework, where it's protecting creditor rights, regulating business conduct, and overseeing recourse mechanisms to protect customers is important. Now, another aspect of this, which often gets overlooked, is the importance of competition policy. So having a healthy competition in the financial sector is not only important for consumer protection, because it sort of increases consumers' market power, but it also provides the financial institutions with the incentives to look beyond their existing markets and try to reach the underserved. So they have greater incentives to adopt technological advances and also adopt and generate new types of products, taking advantage of the behavior of economics literature is teaching us. So one of the studies, again, that we highlight in the report has actually looked at the relationship between bank competition and firms' access to finance using both bank-level data and firm-level data. And something that comes out of that study and is collaborated by other studies as well is that lack of bank competition actually diminishes firms' access to finance. And here, for example, we're looking at the learner index, which is the markup over marginal cost, and one standard deviation increase in the learner index, which is actually a reduction in the competitiveness of the banking system, is associated with about 5 to 6% reduction in the probability of the firms and countries in access to finance, and this sample covers over 53 countries over the years 2002 to 2010. So, in a way, it underlines the importance of competition policy and the government's responsibility to ensure there is competition in the financial sector as well. Of course, when we talk about competition, it's healthy competition. There's always an important role for regulation and supervision. Another aspect of the important role for the government is the role in supporting the information environment. So the standards for disclosure, transparency, promoting credit bureaus, collateral registries. Again, another piece of evidence that we highlight in the report has to do with the impact of reforms of collateral registries for movable assets. So when we look at, for example, we have data from doing business since 2004 for over 185 countries in the way they have reformed their credit registries. And since 2002 to 2010, we have about 73 countries, which is in the sample, and we can look at the impact of the reform of the registry for movable assets. And then again, comparing the registry reformers with non-reformers in a different risk setting, we could see that actually the reformers have about a 10% differential increase in the percentage of firms with access to finance, even after controlling for all sorts of country and time effects. And there's also some evidence that this positive effect is even stronger for small firms. So certainly another piece of evidence that suggests that this type of improved information environment is likely to increase access to finance. Now, I don't have too much time, but basically in the study, we focus on three main areas because these are the areas where there has been the greatest recent sort of empirical advances. One has to do with the promise of technology. As we know, there is a significant amount of sort of excitement around, for example, mobile banking and expanding access. The other area where we've done quite a bit of synthesis, including our own research, is the importance of product design and business models in expanding access. And this again, so incorporates all the new knowledge that's being generated through behavioral economics. And finally, since expanding inclusion responsibly is so important, and an important part of that is improving financial literacy and capability, and that's where also a number of studies are synthesized. Okay, so in terms of promise of technology, clearly technological innovations reduce transaction costs, increase financial security. We know, everybody in this room knows about the mobile technology and what it has done for many countries in Africa, but there are also other innovative sort of delivery channels that sort of use technological advances to expand inclusion. One important force in that is the correspondent banking, so allowing banking through post offices, supermarkets, gas stations, so on and so forth, which also uses sort of technological advances. And an interesting example there is how Brazil has been able to expand financial inclusion in the Amazon through floating banks, for example. Another area where technology has been making an important impact is through improving the identification of borrowers. One example, again, that we highlight in the study conducts a randomized experiment among paprika farmers in Malawi to see how sort of improving the sort of identification of Malawian farmers by fingerprinting them increases potentially the access to credit to them, because now the financial institutions are able to sort of distinguish the poorest from the better risk customers. And there, the study suggests that the impact actually of improved personal identification can be seen mostly in the worst risk customers. So, and this being able to sanction these types of customers actually improves lenders' incentives to potentially expand access. So this is another area which we see around the world, in the improvements in the identification. This is a big undertaking in India these days. Another interesting sort of example here, an area that we are focusing on, as I mentioned, is the role of product design and different business models in being able to expand access. And one example of this is actually the commitment accounts. The commitment accounts are accounts where access to deposits is only possible after a certain amount of time passes. So another randomized experiment in rural Malawi, providing farmers with the opportunity to save through commitment accounts versus ordinary accounts versus no accounts, suggests that having access to such accounts indeed increases the savings as well as the outcomes in terms of, investment in cash crops and land under cultivation and so on and so forth. And what's more interesting, I think, here is that there's a difference between ordinary savings accounts versus commitment accounts, because commitment accounts are the accounts that end up with the highest significance. And when the researchers try to investigate what's really driving the mechanism under which this commitment accounts help, they find that it's actually the protection from the individual's social network that allows the individual to save and have the greater incentive to save. And in that context leads to these outcomes. Obviously, this may have adverse impact on the community itself, but some of the studies, follow-up studies, suggest that that's minimal. Okay, the other interesting example when we talk about product design and business models actually comes from index insurance. As you know, again, insurance products are quite difficult to design for use among the vulnerable populations because these populations, the financial service providers, find it very difficult to assess risk in these populations because of adverse selection issues and moral hazard issues. And the price that then these products are available at tends to be much higher than the actuarially fair prices, or they don't exist at all. So in order to overcome this difficulty, there was this development of a product, weather index-based insurance product, which actually ties the payment to an index of rainfall. In this way, it takes away from the hands of the farmer the whole notion of not exerting effort if you are insured. So it reduces the moral hazard, presumably, or does away with the moral hazard, and therefore allows the price to be sort of at a reasonable price point. Now, interestingly, again, studies in Malawi, in India, randomized experiments suggest that when used, these products are associated with good outcomes in terms of greater investment and greater sort of productivity and outcomes. But one challenge in this type of insurance product has been the low take-up. So farmers found it very difficult to, one, understand what this product is, and two, trust the financial sector provider, because essentially the insurance product is you ask for money you're going to provide in the future, and it tends to be very difficult to communicate what this is to a farmer. So now the second generation of the product development is trying to understand how to overcome this issue and increase take-up, and people are designing products that pay often and fast, perhaps have an endorsement by a well-regarded institution, simplification of consumers, the product so that the consumers understand it better, which brings me actually to the literacy issue. Okay, so talking about the last area of the focus for this whole synthesis report is clearly responsible financial inclusion also requires individuals to better understand finance, and part of that has to do with financial education. But we do look at a lot of studies again here under this topic and try to understand how best to educate consumers. And there, it's clear that classroom-based financial education for the general population does not seem to work very well. So the randomized experiments suggest that that's not the way to go. However, it is financial literacy can be increased by well-designed and well-targeted interventions, particularly provided in what one calls teachable moments. For example, when an individual is starting a new job, or when somebody is sort of about to get a new mortgage. Those are the times to capture the individuals and provide a training. And this is especially beneficial for people with sort of limited financial skills. But it's also important how to deliver this knowledge. It helps to leverage social networks. For example, there's a huge randomized experiment in Brazil trying to teach school-age children, and there it's clear that if you involve both parents and the children, you get much more. And when you try to teach, for example, remittance senders, if you also involve those that receive the remittances, again, you can expand and sort of increase the retention and also the absorption of the knowledge. Another aspect has to do with making sure that the training is provided in a rule of thumb fashion, so sometimes too much information is difficult to absorb. So design of the curriculum and making sure the main points are absorbed is another important issue. And more, there is experimentation with new delivery channels. And it turns out that some of them show promise. For example, a randomized evaluation we conducted in South Africa incorporated financial literacy sort of messages to a popular soap opera scandal. And the whole idea was to try to see if this had impact after the fact. So the messages were run in the soap opera for 2 months. And indeed, the follow-up examination suggested that this led to improved financial literacy skills, although it was very short-lived. So there is the whole idea that this needs to be constantly reiterated for greater retention. So I just want to leave you then the main messages of the report. Basically, what we try to do as a result of this is the main message is financial inclusion clearly can be important for the poor. The poor can benefit particularly from having access to basic payments and savings products. So, but unfortunately, this widespread benchmarking exercise we've done also shows that financial inclusion varies quite widely around the world, with the poor people and the young and small firms facing the greatest barriers. So essentially, a lot of the recent evidence suggests that innovative technology, services, business models, delivery channels hold much promise for increasing financial inclusion, especially profitably and responsibly. And the role of government policy is to address the failures, not to increase inclusion for inclusion's sake, and that's where the responsible financial inclusion issues come in. And the key areas for the government has to do with strengthening regulations, improving the information environment, ensuring competition among providers, educating and protecting customers. So direct government interventions tend to be more difficult to design well and implement well, particularly in weak institutional settings. But there is also some suggestive evidence that offering basic low-fee accounts, waiving onerous documentation requirements, using electronic payments to deposit government assistance into bank accounts, allowing correspondent banking can hold promise going to the future. Thank you very much.
Okay, so I'm the discussant of Asli's presentation on financial inclusion. I'm not going to do a traditional discussion because this is a report. So I'm going to make a few remarks on my view based on my own research on how we can increase financial inclusion. In particular, I'm going to talk about what could be the important role played by foreign institutions and foreign companies in terms of promoting financial inclusion. So I completely agree that the role of the government should be to just set up the scene, set up the stage for the development of credit markets and then at a later stage of capital markets. So basically the role of the government should be to create a legal and regulatory framework that's going to protect credit rights, it's going to protect shareholder rights, and very important to enforce the law. Because we know from a lot of research that it's not enough just to have the laws. What's really critical to investors and to the creditors is that the laws are enforced. And in particular, at the later stage, in these developments of financial development of African countries, financial liberalization, and financial liberalization we put into here, liberalization of the banking system, so the entry of foreign banks, and also the liberalization of capital markets, debt and equity markets, can play a very important role in terms of increasing financial inclusion. So what could be the important role played by foreigners? So in terms of the banking system, as Asli mentioned, competition is very important. And we know that the entry of foreign banks will have a very important role in terms of increasing competition in credit markets and facilitating the access of firms to financing in better terms. In terms of corporations, FDI can also play a very important role. And FDI can be both greenfield projects, but also cross-border merger and acquisitions can also play an important role in terms of financial development of African countries. In terms of FDI, they are known to be a very important source of valuable technology and know-how transfer to local firms. There's a lot of linkage between foreign companies and local firms can help to these technology transfers and know-how transfers that improve productivity and also could improve the corporate governance of local firms. Of course, you need that the countries also have absorptive capacity to take advantage of these knowledge transfer. There also could be crowd-out effects, but overall, FDI can play a very important role in terms of developing the countries. And many arguments that are put forward in terms of economic nationalism, that it's good to the country, that to protect jobs and keep the property of the companies on locals. Many times these arguments just have the goal of protecting private benefits that are enjoyed just by a few local corporate insiders, that they don't want the entry of foreign companies or foreign banks because it's going to increase competition. It's likely to be more pronounced when this foreign competition especially comes from a country which has strong investor protection, and also in cases where there's more product market competition in the industry where there is this cross-border M&A. So competition, again, it's a very important tool in terms of improving productivity and in terms of financial development. Finally, a final note about foreign portfolio investment. So at a later stage, these countries could also benefit from a capital market liberalization that will allow to attract foreign portfolio investments. There is this conventional wisdom that foreign investors, they just seek short-term gains. They have no concerns whatsoever about the long-term prospects of firms. In particular, as foreign portfolio flows are usually called just hot money with no long-term view. At the school, we have a big research agenda on foreign institutional ownership. And we know that financial globalization has been changing the corporate ownership structures of firms, in particular towards more dispersed ownership, and also a rise in terms of the role played by foreign institutions in the corporate ownership structure of firms. So contrary to this conventionalism, what we find on this research agenda is that foreign institutional investors, so mutual funds, pension funds, private equity firms, they are agents of change in a positive way. And the idea is that when you are a foreign institution that is coming to invest in a local firm, you are more independent. And because you are more independent, you could be a better monitor of the management. So while the local institutions, typically they have sometimes their hands tied by business connections and personal connections with the management of the company, because these foreign institutions don't typically have these business ties, they can be very effective monitors of the company and of the management of the company in terms of improving corporate performance and value, the value of the company. They also facilitate value-enhancing takeovers that, for example, could generate know-how and technology transfer to the local firms. And they also play an important role in terms of improving the corporate governance standards of the local firms. So these foreign institutions, they tend to push for better governance, for a more independent board of directors, that it's a stronger monitor of the management, and also to push for a stronger link between executive compensation and the performance of the firm. All right, so this is my discussion. So let's move to the second presenter, Paul Coulier from.
Is that the rule?
No, it's not the rule of the art. I was just trying to keep the conference on schedule, but of course it's a good idea. So we have some time for questions.
I enjoyed both presentations very, very much. I was intrigued by this soap opera connection, and of course the picture was of some interest, but in terms of exactly how you could test that, because again, if you know, you only remember it in the next episode, or if you have to introduce financial literacy points in every episode, I wanted the ratings of the soap opera won't suffer. But I did find your references to Brazil extremely interesting, because Brazil, they had a very high financial development even compared to European countries such as Portugal for quite some time. But because it was so unequal and so poor, it didn't trickle down. So I think there is really a lot of merit in looking at countries who had already the financial structure, but somehow did not think about inclusion. I would think that this is a combination of the intensive and extensive margin of financial inclusion, and that leads me to a question to the discussant. Does the sector where the foreign investment is directed, whether it is financial or not, matter at all in your results? Thank you. Sorry if I took so long.
On the South African study, this is a study by Bilal from the bank. Actually, a large part of the study was to try to sort of figure out how one could test this in a clear fashion. And what we use is this something called encouragement design, where individuals are asked to sort of watch two soap operas at the same time. One has literacy messages, and the control group watches another soap opera that has no literacy messages. And then there's a little test to make sure everybody watched the right soap opera. And the whole soap opera with the literacy messages ran for 2-3 months. And but it is a very popular, both of soap operas are very popular, so they continue to run just without the financial literacy messages. So, but after the financial literacy messages were run, then there was again additional surveys to understand how those people who watched these two different soap operas started changing their behavior. And indeed, the responses suggest that they were conducting themselves much more responsibly. They were not engaging in this higher purchase type sort of borrowing, and they were borrowing less. They were much more careful. But then there were repeated surveys, and the impact only lasted for a couple months. So there is the whole concern that anything like this needs to be repeated continuously for it to have impact long term. But this was an interesting example, because there has been, again, a lot of interest in incorporating these types of public service messages to soap operas. There's clearly there are many health messages that are incorporated, and there is a lot of assertions that these things work without necessarily understanding. So this type of a rigorous impact evaluation provided some evidence for us to go by. On Brazil, I completely agree. So my research on the role of foreign investment has focused on non-financial corporations. Okay? But there's plenty of research also on foreign investments in the financial sector, and I believe that the effects, the benefits could be even more pronounced, because you can, as a foreign banking
fostering and improving competition in the sector, there could be many spillover effects in terms of access to finance by non-financial corporations. Any other questions? Now that we open for questions, we can add a few more. No? Okay, so let's move to the second presenter, Paul Collier from the University of Oxford. There's a slightly change in the title of the presentation.